All right, hi there, and welcome to the Investment Review Committee Income Share Class Update for April 2018. As always, this is Jason Ayers here, and I'm happy to have Lead Portfolio Manager for the Income Fund, Mark McAdam, with me. Mark, how are you today?
Excellent, thank you.
Good. So as always, I know you've got some interesting observazations to share with everybody, so why don't we start with just what's been happening with the income pool?
Okay, so the month we returned 0.19% compared to the overall index, which was up 0.55. It's really more in line with the overall market. And when looking at the year to date, we are in line with the overall market, just a little slightly with some negative returns, like negative 1.02 compared to negative 0.97. So we're still happy with the overall pool. We're happy with the holdings. So it's fairly interesting what we're doing inside of the pool to conform to market conditions. Now, just looking how we structured the pool, looking at the next slide, is that we took we had a significant movement in some of our allocations. Now, comparing the income pool to the TSX 60, we are overweight at the consumer discretionary and underweight the financials and the real estate, but we are overweight the industrials, the IT, the healthcare, and the utilities sector. So we're a little bit more diversified than the TSX. The TSX has a very high exposure to materials, telecommunications, and the financials and the energy sector. So we're just a little bit more diversified because of the overall correlations in each particular sector. So we'd like to kind of not have all of our eggs in one particular basket. Now, looking at the exposure, so because of the large market sell-off, is that we invested all the cash, and we actually shaved some money off of the preferred income, because during the market sell-off, the preferreds were mostly overall flat, and we took a significant allocation in the equity, and we actually took some money off the real estate sector as well, just because with rates going up, real estate does have a particular duration to it. So we did a huge asset allocation shift, and I was really happy how the team performed because we placed a significant amount of buys and sells. So it was a very good execution, and it should pay off in the next few months with some higher returns. If you just go to the next slide, and just with the asset allocation, like we overweighted industrials, the IT, and also we added another utilities, Brookfield Infrastructure. We actually sold the preferreds of Brookfield Infrastructure, and we actually bought the underlying. The valuations were a lot more compelling, and the yields were fairly similar. Now, if you followed the market, there was a large sell-off in the IT. That's why we decided to overweight it, and we actually took the money off of consumer staples. There was a large sell-off in the holding, but we actually sold it off before all the damage was done. So, and with consumer staples, there's not a lot of growth, and there's been a lot of multiple contraction in that particular sector. I know we weren't terribly overweighted, but we as a committee didn't feel comfortable with that particular exposure. So we sold it, and then we put the money into the industrial and IT sector. So we're really happy with the overall allocation and what sectors we're overweighting and underweighting. Now, so when you saw that large shift of dropping the preferred shares and moving to the equities, with the equities, they were all done through covered calls. And if you look what's going on in the overall market, if you see to the left of that large spike, that was 2017. So their implied volatility options were very cheap. Now, in 2018, it's a different market. It's like we've been on a bull market for a long time. The economy is kind of reaching a saturation point, and it is maturing, and so there's a lot more volatility. So in this particular metric is that we are heavily involved with the covered call writing. Options are very expensive. Valuations have pulled back a bit, but we don't see a lot of more room, which as opposed to multiple expansion, which I'll get into the next slide. So this slide here dictates why we're doing covered calls, because options are expensive.
And so you're generating an increased amount of premium by being more active with that strategy.
Yes.
To try to compensate for the slowdown in equity upside.
Yes, exactly.
Beautiful. Perfect.
And now, so looking at here, if you see the green and the white line, the green is a metric I really like. It's the price to free cash flow. So this exhibits the multiple expansion that's happening over the market. Multiple expansion curves is one of the metrics you have to be concerned about bubbles forming. So we are comfortable with the current multiples, but we don't see a lot of multiple contraction happening in the future. And then if you look at the red, that's the dividend yield. So the dividend, a downward dividend yield also exhibits is a sign of multiple contraction. So these two metrics are two metrics that dictate the price per earnings. So I think, and the IRC believes, is that a lot of the growth will be through EPS growth and not the price investors are paying per dollar of earnings. So in that particular field, that you won't see a large upswing in the S&P, you'll just be in line with the EPS growth. So we are taking that particular approach with the covered call writing. So in this market, that covered call writing should outperform the overall market because there's not a lot of room to run and options are very expensive. So that's just some supporting evidence to give everybody an example how we're managing your money in these particular markets. And we are really nimble because when you go back to one of the first or two slides, a movement of 15% with asset allocation from dropping preferreds and buying equities via covered calls of 15% is remarkable. It's a huge shift, and that's why as active managers we add value.
Yeah. Absolutely. Well, listen, as always, Mark, really appreciate your time here this afternoon, and thanks everybody for joining in.